Intel fell 11.3%. Lab scores 53 out of 100. Hold. Say HPC is built on Intel 4, packing 125 million transistors per square millimeter, the densest node Intel offers. That density powers Fovero's 3D stacking, enabling 2 times performance per watt and a clear edge for hyperscalers by 2025. Stay tuned as we break down how that node, not sentiment, fuels today's slide and reshapes Intel's roadmap. Intel's 11.3% price drop today directly reflects the market's reevaluation of its 20A process node. While Wall Street often fixates on software narratives, the physical reality is that Intel's internal foundry is still years behind TSMC's N3E, which is the current bedrock for leading AI chips. Intel's current generation Gaudi 3 AI Accelerator, designed on a 5nm process, struggles to match the raw computational density of Nvidia's Blackwell B200. The B200, leveraging TSMC's N4P node, features a massive die measuring approximately 1,000 square millimeters, packing over 200 billion transistors. This sheer scale, combined with TSMC's consistent process yields, creates a performance advantage Intel cannot easily replicate with its current manufacturing capabilities. The crucial bottleneck isn't just the logic die, it's advanced packaging. Nvidia's B200 utilizes TSMC's CoWoS, allowing for 8 stacks of HBM3E that deliver an astonishing 8 terabytes per second of aggregate bandwidth. Intel's Fovero's packaging is still evolving to achieve such high density, high bandwidth integration at scale. This packaging disparity directly impacts thermal design power, TDP, and overall system efficiency, pushing Blackwell past 1,000 watts. A 1000W Blackwell B200 delivers a level of AI processing performance and memory bandwidth that Intel cannot yet match with their current roadmap. The market is pricing in this silicon reality. Intel's ambitious foundry timeline, though showing progress, has not yet closed the significant architectural and manufacturing gap needed for leadership in the high-margin AI infrastructure build-out. Quarterly financials showing modest revenue momentum for Intel. By Q3 2026, the hawkish Federal Reserve interest rate policy will compress Intel's valuation multiple by 15% as high capital costs choke legacy foundry expansion. The macro environment is a crushing wave. Today's blockbuster jobs report completely erased hopes of a Fed rate cut. With the Fed rate at 3.63% and unemployment at 4.3%, capital is fleeing volatile assets. Intel, carrying a high beta of 2.23, plummeted 11.3% today. The yield spread is normalizing at plus 0.41%, signaling that the free money era is dead. This monetary friction directly threatens Intel's capital-intensive fabrication plants. Even with a 7.2% revenue growth rate, Intel cannot outrun these borrowing costs. Meanwhile, aggressive tariff threats act as a secondary tax, disrupting global equipment shipping lanes. Geopolitical friction is forcing a brutal decoupling of the global semiconductor supply chain. While lithography giants like ASML face trade barriers, capital is rotating into defense-resilient hardware like Lockheed Martin. This is the rise of sovereign compute. Intel sits at the absolute center of this national security mandate. However, building domestic fabs faces severe social headwinds. Rising domestic labor costs and engineering shortages delay execution. Furthermore, public backlash against massive government tech subsidies threatens future CHIPS Act allocations. Wall Street is currently pricing Intel on its weak 53 out of 100 AI score. But they miss the structural reality. Intel is no longer a simple chip designer. It is a highly politicized, capital-hungry sovereign utility. The macro wave will crush its margins before national security rescues its balance sheet. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%. A solid beat that signals strong execution. Management says, forecasted outlook. Here is what the lab sees behind that statement. Intel is trading below its 20-day average, currently at 99.1. Intel management's headline this quarter centers on forecasted outlook and the extensive use of non-GAAP measures, language designed to project a stable future while diverting attention from the underlying cash flow reality. They want you to focus on adjusted numbers, not the core business profitability. Wall Street may celebrate an EPS beat of plus 1971.4%, but the lab looks at who is selling. Insiders net sold 61,280 shares in the past 90 days. This is a clear signal. Those closest to the silicon and the balance sheet are cashing out, not doubling down. This insider behavior historically precedes periods of underperformance or significant strategic shifts. What management is saying is we beat expectations on adjusted figures. What the lab hears is we are managing expectations downwards while insiders offload shares. Last quarter's emphasis on growth has quietly shifted to forecasted outlook, a subtle but critical linguistic pivot. This implies less conviction in aggressive expansion and more focus on mitigating downside. The R&D budget confirms this. $13.8 billion, a minus 16.8% year-over-year reduction. Even as a percentage of revenue, it's 26.1%. This cut signals a lack of conviction in the next-gen process node roadmap, crucial for competitive die sizes and transistor density. Watch for the R&D as a percentage of revenue. If it drops below 25% in the next 10Q, the bull thesis on Intel's foundry turnaround is definitively broken. The momentum breakdown for Intel, RSI sits at 40, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case rests on Ponte Vecchio, Intel's SAE HPC architecture GPU built on the Intel 4 process node. The lithography generation defining transistor density, ramping to hyperscalers, and the integration of Fovero's 3D stacking, a packaging technology that stacks logic dies vertically, which doubles performance per watt by 2025. This hardware pipeline, backed by CHIPS Act funding, secures domestic dominance. But here is what breaks the bull thesis. Export license restrictions on 7nm Xeon processors to Chinese cloud providers instantly squeeze Q2 revenue. Furthermore, any cross-strait escalation halting Taiwan-sourced silicon for 10nm test chips completely halts the IDM 2.0. Intel's integrated device manufacturing model transition, exposing a massive single point of failure. Here is the question Wall Street is too afraid to ask. If Fovero's packaging is the savior, why is Intel still reliant on external Taiwanese silicon for its critical test chips? The answer is that localizing advanced packaging is not just about building fabs, it is about yield chemistry. With a bearish MACD, moving average convergence divergence, a technical momentum indicator, and the stock breaking below support at $99.17, the market is realizing Intel's domestic supply chain is still highly fragmented. If Ponte Vecchio shipments meet yield targets by Q3, expect a rally toward resistance at $129.44 on an 8% earnings lift. If Taiwan supply disruptions hit before then, the stock plunges to $99.17 support. Our 53 out of 100 AI score reflects high risk. We expect the downside path to trigger first as China export curbs drag on Q2 margins. Nvidia dropped 6.2%, and everyone is panicking. The H100 Hopper Accelerator is built on 4nm silicon, delivering 30 teraflops of FP8 performance. It pushes 2 TB per second bandwidth with HBM3E memory, dwarfing rivals and fueling next-gen AI workloads. But the lab score is 61 out of 100. Why? Here's why the sell-off is wrong and why earnings will surge. Nvidia's 6.2% drop today reflects an accelerating physical challenge to its monolithic GPU architecture. The Blackwell B200 pushes the limits of TSMC's CoWSL advanced packaging. Each B200 die approaches the reticle limit, around 1000 mm superscript 2. This monolithic approach drives up packaging yield costs, especially at 1200 WTDP. AMD's MI300X uses a chiplet design, offering a more modular approach to yield. While Blackwell boasts 8 TB per second HBM3E bandwidth, AMD's 192 GB memory capacity is competitive. This engineering divergence signals Wall Street's growing recognition of the AI 2.0 bottleneck. Hyperscalers like Google and Amazon are actively designing custom ASICs to bypass Nvidia's architecture and control their own supply chain costs. These custom chips optimize for their specific data center environments, reducing reliance on Nvidia's high TDP, high-cost solutions. Furthermore, AMD's ROCm is steadily closing the 18-month software gap to CUDA. The market is repricing Nvidia's software ecosystem mode as less impenetrable. Today's 6.2% decline directly reflects this shift as the capital flows towards diversified hardware and custom silicon. Quarterly financials showing modest revenue momentum for Nvidia. By Q4 2026, the escalating global trade friction and persistent high-interest rate environment will compress Nvidia's valuation multiple by an additional 15%, shifting capital towards more geographically secured hardware infrastructure. Today's blockbuster jobs report, with unemployment at 4.3%, has solidified expectations of persistent high rates, pushing the 10-year Treasury yield to 4.49%. This directly increases the cost of capital for Nvidia's massive R&D, research and development, and CapEx, capital expenditure, plans, a significant friction for a company with a beta, a measure of volatility relative to the market, of 2.20. Simultaneously, the return of aggressive tariff threats, specifically targeting global trade, immediately raises input costs and introduces significant uncertainty for Nvidia's highly distributed supply chain. While lithography giant ASML faces intense near-term headwinds, defense primes like Lockheed Martin are seeing immediate demand acceleration, highlighting capital's flight to sovereign compute. This macro squeeze validates the lab's sovereign compute thesis. Geopolitical tensions, from renewed Middle East escalations to trade wars over Greenland, are not mere headlines. They are direct threats to global supply chain stability and access to critical markets. Nvidia's reliance on advanced packaging facilities, often concentrated in politically sensitive regions, exposes it to these choke points. While Nvidia boasts impressive EPS growth, earnings per share growth of plus 214.5% and revenue growth of plus 85.2%, the market is now prioritizing resilience over pure growth. The social and political signal is clear. Governments worldwide are pushing for domestic production and supply chain security. This structural shift, driven by tariffs and geopolitical friction, is a direct repricing of risk for globally exposed tech. Nvidia reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%. A solid beat that signals strong execution. Management says, 2 words designed to project a. Here is what the lab sees behind that statement. Nvidia, compute, is trading below its 20-day average at 200. Management's headline this quarter, robust outlook. 2 words designed to project a business-as-usual growth trajectory while masking the exit ramp. They want you focused on the $1.87 EPS. Earnings per share, the portion of profit allocated to each outstanding stock unit, which topped estimates by 4.3%. While 63 analysts maintain a buy rating, the insiders are speaking a different language. In the last 90 days, insiders net sold 1,912,357 shares. This is not long-term conviction. What management says is they are well-positioned. What the lab hears is a coordinated liquidity event before the macro triple shock of tariffs and cooling demand hits the silicon. The lab tracks the gap between PR and the SEC, Securities and Exchange Commission, the federal agency regulating markets. In their latest 8K, the report filed to announce major corporate events. Nvidia stated their CFO commentary is furnished and not filed. This means it isn't subject to Section 18 liabilities, the legal penalties for making false statements in official reports. They are choosing the path of least accountability. Meanwhile, R&D, research and development, the money spent to develop new products, hit $18.5 billion, a 43.2% YOY, comparing results to the same period 1 year ago, increase. However, as a percentage of revenue, it remains a lean 8.6%. Watch for R&D as a percentage of revenue to drop below 8% next quarter. If that happens, the technical moat is being sacrificed for margin preservation. The momentum breakdown for Nvidia. RSI sits at 34, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Nvidia's dominance stems from its H100 Hopper. This platform sets AI inference benchmarks. The upcoming Blackwell GPU, with CoWoS and a silicon interposer, projects a 30% performance boost, underpinning elevated growth expectations. But here's what breaks the bull thesis. New U.S. export controls block HBM-based GPUs like H100 and Blackwell from key Chinese AI cloud providers. This trims a critical growth segment. TSMC's 3nm node capacity and CoWoS yield rates are hard physical limits. Technically, Nvidia trades at $205.10, showing bearish MACD momentum, flirting with its $205.10 support. The core question: how will Nvidia navigate export controls and secure sufficient 3nm CoWoS capacity for Blackwell amid Taiwan Strait volatility? The lab's answer: Nvidia must design region-specific, throttled chips or pivot aggressively to diversify advanced packaging beyond TSMC CoWoS. The CHIPS Act pushes domestic fab incentives, but that won't solve near-term 3nm capacity. Blackwell's immediate bottleneck is supply chain. The lab's June 4th buy call at $218.66 has seen Nvidia decline 6.2% to $205.10. We acknowledge this recent performance and calibrate our conviction. If Blackwell ships on schedule with 3nm CoWoS yields stabilizing above 70% by Q4 2026, Nvidia could retest resistance at $235.47, validating execution. If export controls depress sales or CoWoS yields remain below 60% through Q1 2027, the stock could break support at $205.10, targeting its MA200 at $198.11. The lab's AI score of 61 out of 100 indicates a cautious outlook. Key data point: TSMC's CoWoS packaging yield disclosures. Today's top signal: NVDA's momentum clearly outpaces Intel's hold status.